Taking a step away from indicators can often leave you lost. The retail trader doesn't understand price action, but rather an algorithm like the stochastic RSI and the MACD, which can all be manipulated. If you take a look at how the market moves, you'll find that it often moves from structure to structure, exchanging hands as it goes along. We call this accumulation and distribution. What we can see is one side of the market lose power and the other side of the market taking over, often expanding in one direction, leaving the rest lost and confused. The average retail trader doesn't understand liquidity clearouts and liquidity grabs. They see it as a stop hunt, but this is nothing more than normal market movement. Institutions trade against institutions, banks trade against banks, and whales trade against other whales. The retail trader just gets caught in the middle. So let's take a deeper look into market structure and understanding liquidity grabs. The first step to understanding the market is to understand volume, or how much liquidity is in the market. The less money traded means that the price is easier to move. For example, a forex pair like euro against the US dollar requires a significant amount of money to move price, if you compare it to Bitcoin. This has got to do with the market cap. The higher the market cap, the harder it is to move price. For any type of market to be active, it requires supply and demand. Someone needs to buy for you to sell. This is why it makes sense to take out unwanted liquidity before making a massive move. The market makers are exchanging hands. Often what you'll see is liquidity clearouts from within a trend. The more liquidity that builds up, the more likely it is that the market makers will take it out, clearing the weak hands out of the market before moving price to a new level and forming a new structure. The smart money trader is aware of this. He sees the liquidity and waits for price to come to him. He doesn't trade the range. He doesn't trade the trend line. He waits for his setup to play out, entering into a winning position. The market makers understand how retail trades. They understand support and resistance, setting price up to trap them into poor positions before reversing price in the opposite direction. The smart money trader can see liquidity and will often take his orders around these areas where retail have placed their stop losses. But why does this happen? The institutional trader or whale cannot place an order in a low volume zone because he might push price too much with his large orders. So he uses the liquidity to place his orders. He needs someone to buy into his sell position, or he needs someone to sell into his buy position. This is why you see aggressive movement when liquidity gets cleared. The market maker is filling his orders. Liquidity buildups are easy to spot, and it is located when you see price constantly bouncing from the same area. The smart money trader understands that retail are taking their positions, putting their stop losses above or below the zone. And now, the institutional trader is looking to get his orders filled. For a retail trader like you and me, we should look out for these patterns and join the game of the market makers. We need to target liquidity and get into our positions the same time the market makers do. But what do we look for? Wait for a critical high or low to get taken out, and then wait for a rapid reversal back into trend. The speed of the rotation normally depends on the time frame you're on, but it shouldn't take longer than 15 to 30 minutes, as the market makers need to get their orders filled quickly. In crypto, these events will happen much faster, as the markets are much more liquid. So how do we position our entries? When we look at a trend line, we can see price rejecting multiple times. We need to look for the initial supply or demand above or below the trend. This will be the target at which the market makers will push price. However, a range is slightly different. The market makers understand that price are both buying and selling in the range. So what do? We look for one side of the market to get taken before reversing price, taking out the opposite side, thus clearing out both buyers and sellers. This is when we will enter our position.